Welcome back to Ask the Compound, the show where you ask and we provide the answers. I am Ben Carlson. Let's say you have $3 million stashed away for retirement. No heirs, no one to leave the money to. You want to spend it all and die with zero. What should your withdrawal rate look like? How much should you spend each year? How much can you spend each year? We're going to answer these questions and more on the show today. Stick around. All right, our email here is askthecompoundshow@gmail.com. Send in your questions. If you're in the live chat on YouTube, if you're in the live chat on Twitter, send us your questions there. We'll take them live. On today's show, we will be answering questions straight from our compound viewers about how many stocks outperform the market. What should your spending rate be if you want to die with zero? How diversification works in practice. What do I think of the Dave Ramsey portfolio? And then when should you begin diversifying your 529 account to spend for your kids' college fund?
How much of an allocation to Beyond Meat does he recommend?
For my 529 plan?
No, for Dave Ramsey's portfolio.
Yeah, negative 5%. It's a put option. All right, today's show is sponsored by Public. Public is the investing platform for those who take it seriously. You can build a multi-asset portfolio of stocks, bonds, options, crypto, and more. You can also access industry-leading yields like the 3.8% APY you can earn on your cash with no fees or minimums. But what sets Public apart? AI isn't just a feature, it's woven into the entire experience. From portfolio insights to earnings call recaps, Public gives you smarter context at every touch point. Plus, earn an uncapped 1% match when you transfer your portfolio. That includes IRA transfers, rollovers, and even contributions. Fund your account in 5 minutes or less. Visit public.com/ATC. That's public.com/ATC, paid for by Public Investing. Full disclosures in that podcast description. Hit the link.
Nice disclaimer read. I like that.
Thank you.
Good.
Let's do it.
Yeah. All right. Up first today, we got a question from Coleman. Could you guys talk about what percentage of stocks that are beating the S&P over the last 5 years also beat the S&P the 5 years before that? I'm curious what names appear on both lists, pre and post-COVID, and pre and post-AI boom. I'd like to hear how stocks that beat the S&P over a 5-year window tend to fare over the next 5 years on average.
Great question. There's a lot of studies that show about mutual funds and ETFs that over and underperform, and we're going to get to that a little bit too, but I never looked at this over a 5-year period. So I punch this into Y charts. They have this cool portfolio analyzer tool. So over the 5-year period from 2016 to 2020, the S&P 500 was up a little more than 1%. Okay, and over the past 5 years, and I'm counting this year as a whole year, we're almost there since 2021, the S&P is up like 92%. Both very good returns, right? We've essentially doubled both of the last 5-year periods. So how many stocks actually outperformed over those periods? Duncan, how many do you think outperformed from 2016 to 2020? Out of the S&P 500, how many stocks outperformed the index?
200.
Yeah, it's 150-ish. So like 30% of the total. And there's a caveat here that some stocks have moved into and out of the index over time, so the numbers aren't perfect. So I think it's like 2 to 4% annual turnover of stocks coming in, stocks going out. So in the last 5 years, starting in 2021, 241 stocks outperformed the index. So that's more like half. Hang on, chart off real quick. It's a lot of the names you would expect. Microsoft, Google, NVIDIA, Broadcom, Facebook. I got ahead of myself. So how many stocks have outperformed both periods? Remember, 150 in the first 5 years, 240 in the next 5 years, so it's like 30%, 50%. It's about 41 stocks that have outperformed in both periods. And it is the stocks you would expect. Microsoft, Google, NVIDIA, Broadcom, Facebook. There were some surprising names here. Hilton Hotels, which is surprising because hotels got dinged so bad at the outset of COVID. Caterpillar, Decker Outdoors, which is like Uggs, and I think my daughters are keeping Uggs.
Hoka, right?
Hoka shoes, yeah. If you're a middle-aged dad, you know what Hoka shoes are.
I love Hokas.
Tiva, right? If you've been to Burning Man, you've worn some Tivas before. Walmart is on the list for both of them. So it's some surprising names, some you think. And it's interesting. I know the stock market is getting more concentrated by the year, but the number of stocks that outperform is higher than I thought initially. So let's do a chart on now. Chart Kid Matt did this one for me. This is the number of companies outperforming on an annual basis, going back to 1990. So the average is 239 stocks. So it's almost half of the stocks outperform the actual total return of the index in a given year. It's kind of funny because it's like an ominous sign. These numbers dropped really bad in the 1998-1999 period, just like they did in 2023 and 2024. And of course, the end of the 90s was the end of the dot-com bubble. So take for that what you will. So anyway, I think the number is higher than people assume, especially since the stock market is so concentrated. This is surprising, right?
Yeah.
Chart off. It surprises me. All right, now here's the thing.
Yeah, I'm actually surprised that there's that many that outperformed over both periods. That's
right?
That's way higher.
Yeah, it was higher than I thought too.
Yeah.
I wonder if this last 10-year period is actually the outlier there. It would be a ton more work and data to look over these other 5-year periods. We'll see. It sounds fun to do, but I'm not going to do it. I'm sorry. But I would imagine that's pretty high. Yeah, but again, it's a lot of them the tech stocks that you would assume. The funny thing is that picking the stock pickers that outperform might be even harder. So Spiva does this thing every year. They call that their persistence scorecard, right? They have one at the year-end 2024, and they look at how many mutual fund managers that outperformed over a certain period. They look 5 years, outperformed over the next 5 years. So let's show the chart here. 2%. This is just the top half. So 2% of all large cap equity funds remained in the top half over the 5-year period after they were in the top half before the previous 5 years. Okay, and that's just the top half. Very small number among top quartile funds as of December 2020 that had outperformed in the top quartile. Not a single fund remained in the top quartile over the next 4 years. Okay. And none of the top quartile funds from 2022 maintained their position in the top quartile for the subsequent 2 years. And they said if it was just a random chance, it should have been at least like 6 or 7%. Chart off, please. So I think the takeaway here is just that buy and hold in individual stocks is probably your best bet. The people that try to pick the stocks and jump in and out, they do way, way worse. And it's really hard for them to outperform. So I do think that your best bet is going to be buy and hold stocks.
Even though that's not nearly as much fun, but
right.
Yeah.
In the chat, someone says it sounds fun to do, but I'm not going to do it. The Ben Carlson chart philosophy. That's fair. That's why we hired Chart Kit, so I don't have to do it anymore.
That's true.
All right, next question.
Okay, up next we got one about the 4% rule. I understand
people love the 4% rule. We get questions of this all the time.
Yeah, I hear it more and more. I feel like every year. Yeah. Let's look at it, Dan. I understand the 4% rule, the risk-adjusted guardrails by Kitces, etc. I started my life as an investment banker at Goldman, so I can manipulate a spreadsheet, though I'm rusty. Here's my question. I assume I'll have $3 million squirreled away in investment accounts by 2026. That's a not to brag.
Yep.
Leaving any tax implications aside, this would give me $120,000 per year, assuming the 4% rule. I don't want to leave any money behind as I can't take it with me, so if die with zero is the plan, what would a safe withdrawal rate be?
Great question. Here's a guy who has no trouble spending his money, right?
Yeah.
I'm guessing he said no one to leave behind, right? So he's got no kids or heirs or anything, or he's just going to say screw the kids, I guess. Can't take it with you, right? So, all right. So Bill Bengen is the father of the 4% rule. He has a new book out. Show that here. It's called A Richer Retirement: Supercharging the 4% Rule. I read the book recently. He was on our Talk Your Wealth YouTube channel about a month or two ago, and it's on podcast form now too. So check out Talking Wealth and podcast. And I interviewed him about all about the 4% rule. In this book, he goes through a million different examples about the 4% rule. Now, just as a reminder, what is it? Your 4% rule looks like this. You take your starting portfolio value in day one in retirement. Take out whatever percentage withdrawal you decide on. If it's 4%, let's say it's $1 million portfolio, you take out $40,000. In the next year, if it's 5%, it's $50,000, right? So on. In the next year, you slap on your inflation rate of choice. Let's say it's 3%. That in year two, your spending would go from $40,000 to $41,200 or something. In year three, it's like $42,500. So you're not just taking a percentage of the portfolio each year because that'd be too volatile. If the portfolio is up and down big, you don't want your spending to remain relatively constant, right? Most people do, right? Because they're used to that with their income. All right, so that's the 4% rule. Now, this is the money chart for the book. Let's do a chart on here. He has a million charts in the books, but this just shows your initial withdrawal rate and your percentage of success over time. He goes back to 1926 in the book. So it is important to understand what the safe means in terms of withdrawal rates here. He's talking about worst case scenario. So he says now the safe withdrawal rate, the safe max he calls it, is 4.7%. And that just means it never failed historically. The other ones still have a high probability. You could go out to 6% and it's 75%. 7% is like 50% or so. Chart off, please. So he says when he did his initial work, he said by safe, I meant that 4.145%, which is the original number, even though people call it the 4% rule, represented the worst case scenario. And this happened one time in October of 1968. He did it on like a monthly basis, right? And that was because the inflation rate was so high in the 70s and the returns were so low that inflation swamped your spending. So he said it happened literally one time. But he also said, if a retiree indiscriminately used this safe max rate for their withdrawal plan, they'd be sacrificing on average 35% each year in withdrawals, a considerable reduction in lifestyle. So he's saying, like, yeah, this is the really safe choice, but come on, people. Like, that's the worst of the worst of the worst case scenario. It's not going to happen for everyone.
That's what he's saying.
Yeah. Yeah. So pull the chart back up real quick. So I think for the die with zero strategy here, I think I'd be comfortable 7%-ish. I think that's about a 50-50 chance. I think if you really want to roll the dice, I think that's a pretty good spot to be in. Half the time it fails, half the time it does just fine. I think that's okay.
Well, because you're saying you would adjust year to year. So if the market drops drastically, that impacts how much you take out.
Chart off. Well, no. You're not
No.
the 4%
Okay.
rule. You're not supposed to adjust each year. You just adjust by inflation. That's how it works.
Okay,
If
I
you
see.
do adjust by the market value of your portfolio, your
That's
spending is
market
going to
timing.
be all over the place.
Okay.
Now you could say, listen, the whole point is your life isn't like the 4% rule, like a spreadsheet. You're going to have to be more flexible. So you can always cut back later in life. Maybe you spend more upfront in your 60s and 70s, cut back in your 80s and 90s because you're not going to have as much. Your health is going to be worse, probably. You're not going to have as much energy. Or if things are looking better than expected, you can bump it up, right? Hey,
Right.
I mean,
Well, that's what I was thinking is he does 7%, like you're saying, 1 year, and then there's a big crash, in stocks, and the next year we're like, I'm just going to do 4%.
Yeah, the biggest thing for retirees is probably sequence of return risks. So if there's a big bear market right at the outset of your retirement, then you should probably pull back a little bit. And like, okay, and then you can always increase it in the future if things come back. So, and it's also important to remember, he uses a 65-35-5 portfolio. So it's 65% stocks, 35% bonds, 5% cash. He looks through all these different scenarios in the book about different asset allocations, different inflation rates, all this stuff. So there's a million different things you can do. I think flexibility is the key here, though, right? So I think that's the point. You're right. It's if things go way better than expected, turn the dial up and spend way more. If things go way worse than expected, especially right at the outset of recession of your retirement, then I think you gotta chill a little bit. Steven in the chat says, "What happens when AI allows us to live to 200?" I'm not gonna want to live to 200. Sorry, that sounds awful to me.
Well, hey, how much money do you need in retirement if your brain's
Well,
just in a vat?
Compounding can just go forever, right? Yeah, the government will be paying us all anyway to not work anyway. So, but I just think good on the Goldman Sachs banker here. Good on you for enjoying your wealth. I think it's nice to go from delaying gratification to actual gratification. So
Also, I can hear some people in the chat saying sound stingy, leave money to charity. Well, he's not saying he's not going to give money to charity. Maybe he just wants to do that while he's alive.
yeah, this
and
is just
see
how
the
much he's taking out of his
benefits
portfolio. Yeah, that could be part of his budget.
So yeah,
Yes.
exactly. Yeah.
Agree. But yeah, you're right. It's something not a lot of people talk about in the finance world, but that's something you could spend on. All right, let's do another one. But I like the mindset, the die with zero mindset. I like it.
Yeah, I mean, I think everyone likes it except for rich kids, probably. Right?
Yeah, but maybe
They don't want to hear their parents. They don't want to see their parents with that book.
Yes, that is true. You don't get your parents to die with zero as they're reaching their 70s and 80s.
Yeah. Okay,
right.
up next, we got one from Gareth, which is very British sounding. Very British sounding.
Isn't that the name of the Dwight guy in the British version of The Office? Gareth?
I believe so. I think that's
All
right. Okay, at 18, I built a simulated portfolio and compared it to the S&P 500 over the past decade. To my surprise, the S&P 500 outperformed my diversified portfolio by over 2.5% annualized. I had always assumed that more strategy and diversification would produce better long-term results. Why does simply investing fully in the S&P 500 appear to outperform more complex approaches? Is this truly a superior strategy for long-term growth?
All right, 18 years old. I am constantly impressed by the number of young people who are interested in the markets. It's really cool.
Yeah, love to see
Hang on. JC in the chat asked, what if a pension is involved for the 4% rule? Okay. The spending from your portfolio is after all other income sources, right? So how much do you need to spend? Does it come from a pension, Social Security, and then your portfolio? How much of a gap do you need to fill? That's the part of it that matters. All right. So here's the thing, Gareth. He's looking at the last 10 years. Diversification doesn't always work. The past 10 years, the S&P 500 has beaten pretty much every other traditional asset class. It's not always like this. Let's do a chart on. I created this earlier this year. This is the benefits of international diversification. And my whole point here is that it's the decades that matter. And this shows developed country stock markets going back to the 1970s. And you can see in the 1970s, in the 1980s, the U.S. is actually towards the bottom of the rankings. The 1990s, the U.S. did better. 2000s, much worse. 2010s, 2020s, U.S. is at the top. So the fact that the U.S. has outperformed over the last 10 years, that doesn't happen all the time. Let's do the next chart. This is one of my favorites. I've used it a million times. It's the lost decade from 2000 to 2009. The S&P 500 lost 1% per year, including dividends. International stocks, mid-caps, high-yield bonds, small caps, emerging markets, REITs, all did much better. In the last decade, if you diversified, you felt really, really much better about yourself than people who had all their money in the S&P 500 and large-cap stocks. Chart off, please. So the point is that, yeah, sometimes diversification doesn't work. The S&P 500 does have an awesome long-term track record. You don't have to diversify if you're 18 years old. I do because I know those lost decades can and will happen. I think the biggest thing for you is to keep investing and allowing your money to compound in the stock market because you're way ahead of the game at 18. You probably don't need to diversify that much, but that's why you do it. Those lost decades can and will happen.
It is funny to me, being someone who came from film and the arts. It's very funny just watching people time and again try to beat the market. Like, and I mean professionals, right? Of course, individual retail people have fun, but yeah, watching professionals try over and over and over again, and just seems like 90% of them fail. It's just kind of bizarre. It doesn't matter how smart you are. It doesn't matter what a great plan you have. It just seems like the market just keeps winning in general.
So when I first started my career, one of my roles was helping to pick the managers for our portfolios, right? And we would interview these managers, and they all had an amazing background, right? It was all Ivy League people, like very impressive individuals, super smart. They would talk to the different supply chains. They would talk to competitors. They would talk to company management. They knew these companies inside and out. And to your point, most of them still underperformed. And that's when I thought, like, what chance do I have to outperform? If these really smart people can't do it, what chance do I have? And so I kind of went down the same path. Now, there have been plenty of retail people this cycle who have done it, and good on them for doing it. But it's very hard. I agree.
Right, and I think most retail people that have made a lot of money recently would admit that they're probably not going to be able to keep it up for 10 years.
Most people understand. Yeah. A lot of the people we talk to say, hey, listen, I hit the lottery, I hit the jackpot with a couple individual stock picks. Now I know I need to diversify. So that's right. Kind of cool to see that people that understand, like, this, I know this, I can't consistently keep hitting home runs like this. It's not going to last forever.
Yeah, so be careful out there. All those young people watching today, because you're playing meme stocks, be careful.
Yeah, all right. Someone asked, is Ben one of those retail people? I own like 2 individual stocks. No, I don't think I can call myself I own index funds pretty much.
I've outperformed over the last year, not to brag. So,
okay. Yeah. Duncan, a year? Come on, get out of here. Next question. A year? Okay. Here's nothing. Next question.
Just don't look at 5 years. Okay. Up next, we got a question from Nick. What are your thoughts on the Dave Ramsey investment strategy, which includes investing equally across 4 types of mutual funds? 25% in growth and income, which is large cap, 25% in growth or mid cap, 25% in aggressive growth, meaning small caps, and 25% in international funds.
All right. Credit to me for not doing the Dave Ramsey meme, which has been going on social media lately. Have you seen these?
I've seen a lot of Dave Ramsey memes.
Yeah, he kind of has his arms crossed, and he's not happy with what the people are telling him.
Oh, okay.
Listen, I thought about going to Portfolio Visualizer or Y Charts and running this portfolio through a back test, but then I realized it doesn't really matter. Like, there are plenty of different asset allocations that can work. A portfolio of small caps, mid caps, large caps, and international stocks, like, to me, that's a fine allocation. I see no problems with it. I'm sure some people could quibble if they wanted to. What about 10% more in this? What about 5% less in this? Why don't you include this? What about this strategy? There's always a million little ways you can tinker, but I think getting the big pieces right up front, it's the whole idea that perfect is the enemy of good. So I think this allocation is fine. I think the biggest thing that matters with allocations, because there are so many other things to invest in these days, is you're always going to be tempted to add something else or take something away. Like, why do I own this piece of junk? It's underperformed for 3 years. Get it out of there. I'm putting this thing in that did really well. I think that's the problem. It's just the allocation probably matters less as long as you get the big building blocks right than like your ability to stick with it, right? Is a 70-30 portfolio going to be that much different materially from a 60-40 portfolio? Probably not. Is a 10% allocation of small caps going to be much better or worse than a 15 or 20%? No, it depends on the cycle, but probably not. So I think can you stick with the allocation, and will you rebalance back to those initial targets on occasion to keep yourself honest?
I haven't listened to him in a very long time, so I'm out of the loop. But I'm surprised he doesn't have any gold. He strikes me as someone who would be into gold.
Dave Ramsey does seem like a gold person, and I never really listened to him. I know a lot of people who got into the Dave Ramsey after
He's
college.
usually number one on the business podcast charts.
Yeah, people like his and he has strong opinions. I know a lot of people who did his envelope method for budgeting right out of college, right? That's like you food and entertainment, and you have this money in the envelopes, and for budgeting, people get on him for his investment takes. Sometimes I think he told people they could take like 8 to 10% of their portfolio for their withdrawal rate or something, because if the stock market gives that percentage, then you're fine. So people quibble with all of this stuff. He does. I don't know. The portfolio, as far as I'm concerned,
he's very anti-student loans. He basically doesn't think you should go to college if
he's not a debt
to
guy.
Take out loans. But
Yeah.
Yeah, the main thing I have a problem with is
that.
He tells people credit cards are always bad, basically. And I think he says he carries 2 debit cards and his concealed carry permit or something like that. That's all he has in his wallet. Just as someone who has dealt with, identity theft in the past and that kind of thing, debit cards are not what you should be spending all your money on, because it's very hard to get your money back comparatively, right? If you spend money on a credit card, someone gets your credit card number, that's on the credit card issuer to get their money back, right? A debit card, if someone gets your debit card and spends money on your debit account, that's your money. You're having to fight with the bank to get back. So that's my main thing.
If you have an errant charge on your credit card, they used to grill you about it. Now they don't even care. Like, yep, sure, here,
just immediately
card's canceled, new one's on the way.
Very different with a debit card at most banks. So that's my main quibble. I would just say, if you can be responsible and pay off your credit card, they have a good purpose.
Yeah, because his whole thing is paying down debt, and you have to think of the audience he's talking to. Right. But do I have a problem with his portfolio? No, as long as you can stick with it, it seems reasonable to me. I don't have any huge issues. I think there's a ton of different allocations you can use. There's not like one that's like, this is the one. You have to use this. There's a lot of them. It's just like, are you going to be willing to stick with it? That's the thing that matters.
Right.
All right, let's do another one.
All right. Last but not least, we got one from Brian. If you were doing a 100% S&P for a 529, at what age would you switch to a target date fund? 5 to 7 years out from the start of college? I don't want to use a target date fund from the day they were born. That's too conservative.
Okay, this is a question a lot of people ask as they approach retirement as well. Like, when do I start, de-risking? Because I can't. A lot of people just can't have all their money in stocks. There's a few reasons why you want to de-risk, right? One of them is emotional volatility. You can't handle investing in all stocks, and that doesn't matter how old or young you are. That some people just can't handle having all their money in stocks and seeing the volatility and the potential for loss. Some people want to have a safer component because they want to rebalance back into something, bonds or cash or some sort of hedge. And then other people know that the spending has to happen. So if you have spending in a certain period of time, you don't want to have to be spending stocks because they could go down in a hurry, right? So I think he said 5 to 7 years out. That seems pretty reasonable to me. Like, you have an 18-year time horizon or potentially 22-year time horizon, 24-year, whatever, however long the kid goes to school. I think that's pretty reasonable to start going down. And I think probably if you're worried about it, and he said he's got all of the money in the S&P. I know plenty of people who do that. Spoiler alert, I'm a target date guy for the 529s, always have been. Maybe I have less money on the table. I'm fine with that.
I know nothing about 529s. Is this just like an account that you can invest in anything in, or does the issuer restrict you to certain funds?
They usually have fund choices for you.
Okay.
Depending on, so I invest.
So you're not investing in like individual stocks usually in a 529, right?
Nope, I'm invest. There's funds, there's index funds, there's some active funds, and there's some target date funds. And I picked the target date fund, and you pick like a target date for the year of when they're going to graduate. If you want to take more risk, you can go out a little further. Hopefully, one of my kids gets a full ride, and then I can just roll that over to a Roth IRA for them. I think you could probably, to make life easier, instead of ripping the Band-Aid off, do it in tranches, like a reverse dollar cost averaging, right? Starting 7 years out, I'm going to take, 10% of it every 6 months or something, and slowly but surely get to my goal, whatever that goal is. Maybe your goal is a 60-40 or 70-30 or 80-20. I like the idea of doing it slowly but surely. I think most people, it's easier for them emotionally to handle that. Plus, with the stock market, you're allowing it to run a little longer too. Now, that could set you up for more risks, obviously, but I think that makes sense to me. So I don't think that's too conservative. I think the plan makes sense. The thing is, there's no perfect situation for this because you don't know what the market's going to do, right? If the market rolls over, you would have been better off ripping the Band-Aid off. If the market keeps going higher, you've been better off slowly but surely tranching out.
Yeah, and if your kid looks like they're going to get a full ride, you're going to think, man, I could have bought that car, could have done all kinds of cool things with that money.
Maybe AI will just take care of them in the future anyway, and there's no need for college.
I mean, yeah, sure. It's a possibility.
Yeah, but no, this is the kind of stuff you have to think about. So I like the mindset. Really good questions today. Really diverse set. I always like it. If you have a question for us, remember our email here is askthecompoundshow@gmail.com. Thank you to everyone in the live chat as always. I thought they were going to ask us about our questions today, but they're asking each other like what they're doing on the weekend, and everyone's just hamming it up in there.
It's a great community in the chat.
Yeah, appreciate all the people watching live on Twitter as well. idon'tshop.com for all your compound merch needs. Subscribe, like, review, all that good stuff, and we'll see you next time.
See you, everyone.